last week, Rupee maintained a stable environment and hovered in the range between 70.75 to 71.22. Rupee held its firm resistance at 70.50 due to determined intervention from RBI, which averted the currency's rise beyond that level. The possibility of the rupee to test the 71.50 level before the month end is very much possible due to increased dollar demand expected from corporates and government agencies. We expect the base level of the rupee to establish the 71.00 level and anticipate the currency to move in the range between 71.00 to 72.50 up to the end of the current financial year with a weaker bias. Moody's indicated that the investment-led slowdown has now broadened into weakening consumption and slashed its forecast for the country's financial year 2019-20 growth rate to 4.9%, down from a previous downgrade at 5.8%. Amid gloomy macroeconomic indicators in the domestic economy, the external position of the country is very robust, with a sharp increase of over 42 billion in forex reserves from the beginning of April till date. The comfortable balance of payment position augurs well for the rupee over the medium term. The growing fiscal deficit is the main concern, and any change in the rating outlook by S&P from stable to negative post-budget shall take the rupee much lower over the medium term before any recovery can be seen. From the beginning of January till last Friday, the BSE Sensex recorded a significant rise of 15.25%, and the corresponding equity inflows were 13.5 billion USD, the highest since 2014. After the budget announcement on 1st February 2020, the position of fiscal deficit shall become clear, and any slippage in the fiscal deficit beyond the 4% mark would increase the negative sentiment on the rupee exchange rate, leading to portfolio outflows which could pressurize the rupee. However, the huge forex reserves of the country shall protect the rupee from falling beyond the 73.00 level till the end of March 2020. The rally in the BSE Sensex still continues, recording new lifetime highs from the beginning of last week. We have observed in the last 5 calendar years that huge portfolio inflows received in one calendar year is followed by net portfolio outflows in the succeeding calendar year. Due to Operation Twist process to be adopted by RBI from today by buying of 10-year sovereign bonds with simultaneous selling of various bond issues maturing in 2020 would facilitate a flattening pattern in the sovereign bond curve, which could lend to the 10-year sovereign bond yield to drop significantly lower. This week, being the last week of the calendar year, could see some dollar buying toward the fag end of the week, which could take the rupee lower 72.50 level or lower. With the complete turnaround in the interest rate outlook from both the Fed and RBI, maintaining status quo over the rates in CY 2020, the forward drifted higher across the maturities. The sharp paying interest in the swap market can be attributed to intervention-related paying by Reserve Bank of India by way of undertaking sell and buy swaps with banks to shift their huge dollar purchases into forward dollar book. Exporters are well advised to sell their medium-term receivables in tranches targeting a spot level between 71.50 to 72.00 and combined with the higher forward dollar premia available in the market for 4 to 6 month maturities, the export realization would be much higher for the exporters. The importers who have missed to hedge their month-wise short-term payables up to 3 month maturities when the spot was trading near 70.60 level or so, with the lower forward dollar premia prevailing at that point of time, can now look to hedge their exposures targeting a spot level of 70.80 or better. Postponing of the hedges against payables may prove to be a costlier option over a period of time.